Good morning, everyone, and welcome to another session of Decipher with Deserve. Today is Saturday, the 28th of February, 2026. I'm Kushal Karkare from the investment team at Deserve. I work on portfolio analytics and market insights. And thank you very much for taking the time to join us here on a weekend. We truly appreciate it. The timing of today's session is particularly relevant. We've just come out of an earnings season. Most companies across large caps, mid caps, and small caps have reported their numbers. Management commentaries are out, guidance has been reset, and the markets have reacted, and the noise phase is more or less over. Now comes the interpretation phase. And after every earnings season, a familiar set of questions resurface. Was this quarter a one-off or a trend? Are earnings downgrades behind us? Have mid and small caps corrected enough? Should allocation move back towards large caps? And most importantly, how is my portfolio positioned after all of this? Which brings us to the core theme of today's session. Today is not about reacting to one quarter. It's not about chasing earnings beats or exiting on misses. Today is about what this earnings season has actually revealed about profit trends, expectations, resets, and valuation comfort, and how portfolio should be repositioned in response. Because earnings don't just move prices for a few days. They reset narratives, they reshape forward growth assumptions, they influence how capital gets allocated across sectors and market caps. In today's webinar, we'll decode a few key things. What corporate performance actually looked like across large, mid, and small caps, which sectors surprised both positively and negatively. Secondly, how markets react relative to expectations, where the gap between narrative and numbers are the widest. And third, what valuations are signaling now post results. And finally, how our Deserve portfolio is positioned across these developments. Joining us today is Pratik Bagaria, the Principal Officer of our PMS business at Deserve. Pratik oversees how portfolios are constructed, how risk is managed across asset classes, and how earnings data translates into portfolio positioning across large, mid, and small caps. With over 20 years of experience across multiple earnings cycles, he's seen that long-term returns are not driven by reacting to quarterly volatility, but by staying aligned with sustainable earnings growth and valuations discipline. Pratik, welcome. Great to have you with us today.
Hey, hi. Thanks, Kushal. I hope I'm audible.
Yes, yes, you are.
Great. Good morning, everybody.
So, folks, before we dive into the nitty-gritties of it, I'd like to cover a few things on what you can expect from this session. So, firstly, what we will cover, we'll cover an earnings recap for Q3 FY26 across market caps, which is your large, mid, small, what the numbers are actually telling us. And finally, a broad playbook in terms of what you should be thinking right now from the perspective of your investment portfolios, and not granular fund level, scheme level, security level discussions. We will not be covering any fund specific recommendations. This is purely a market and earnings discussion and not a person to person customized advice. Also, there's a Q&A segment in this Zoom window. Please feel free to drop your questions whenever you have any, and we'll make sure we address them towards the end all at once. And finally, at the conclusion of this session, you will be faced with a short feedback form. I sincerely request all of you to fill it out. Your inputs help us improve and keep delivering great content. Uh, Pratik, over to you. We've seen a new GDP number come out just last evening.
Yeah.
A few things about this. There's been a change in the series on which GDP has been computed. Maybe if you could walk us through what's happened and what this signals.
So, in order to improve the quality of data and the GDP that we publish, the government has announced a new series. Again, not the first time a government has been changing series. It happens, you can say, once in 10 years, 12 years. Last series going on was for as on 11/12 to the, and we have changed that now. The key change here would be that Earlier, the earlier series used to have only one deflator. So across all the sectors, you had only one inflation number that was being used. Now there are multiple deflators for manufacturing and or do two deflators for manufacturing and agriculture. What this basically does, it helps you make better estimations. And there are multiple ways of calculating GDP, right? You can take the expenditure method or the production method. uh, Ideally, the difference between these two methods should be the lowest. So the new methodology will help in reducing the discrepancy between GDP calculated via various methods. But yeah, the number as well that we saw yesterday, which was 7.8%, was pretty encouraging. If you can, like you see on your chart, this is still one of the highest growth rate that we have seen over the last 8 quarters or so.
Right. So, I mean, just to call it out here, the quarter before last we saw a stellar number at 8.2. Now, in the revised series stands at 8.4. Is this something we should be concerned about with the slight drop in this number this quarter?
Uh, Not really, because yeah, last quarter it was 8.2. Uh, yeah, in fact, if we just go granular, uh, it is better this quarter because manufacturing is supported more the economy more than anything else. The consumption is back, so none of the indicators tell you that this is a worrying number. 7.8% is a pretty healthy growth. We all know that 8.2, that the number that came in last quarter, was not the sustained or not the long-term estimates. None of the economists were forecasting that we will have an 8.2% sort of a growth even back then. And now the estimates continue to be in the range of 7.5% to 7.6% GDP growth for India in FY 26, 27.
Got it. So, I mean, diving into the earnings segment, can you just quickly walk us through what's happened across, firstly, the large caps, how it's looking across sectors, and what this actually means for us?
Sure. So large cap, if we just look at the overall sales growth of year on year, we saw in December 25 quarter, we had a sales growth of 8.7%. The profit growth was 15.7%. And this was both sales growth and profit growth were higher compared to the previous quarter. That you can see from the chart towards the right, where you see the black line going inching up, and also the cream line inching up in the last quarter. So sales growth is robust at around 8.7, pretty much in line with the GDP growth, and profit margins are also stable at around 13%. Given that scenario, within sectors, if we try to look, the top three sectors for sales growth were real estate, materials, which also include a bit of mining and metals, and you have communication services, which will include the entire spectrum of telcos and infrastructure, telecom infrastructure companies like Indus. But in terms of PAT growth, the cyclicals like materials, metals, and mining, they saw a larger growth year on year. So you'll see the materials doing 41% YOY PAT growth. So that is a little bit cyclical also in nature. Similar with energy, 32.6% YOY growth. At the same time, the more stable sectors like your consumer discretionary, IT, I hope it's stable going forward as well. But the industrials, those were again around 16, 17%, which is a very healthy growth number. Real estate is doing 25% YOY PAT growth, which is very encouraging, backed with sales growth also.
Right. Just to call it out, I mean, these numbers that we're seeing, consumer discretionary, consumer staples, are they also a function of what's happened via government boosts over the last year in terms of GST cuts and
Absolutely.
infusion of liquidity?
Yeah, so last 2 quarters we've been seeing the effect of the rate cuts, the monetary policy, and the fiscal policy, which is your GST cuts, etc., playing out into the numbers.
Got it. And in terms of just the few, like, not stellar earnings here in terms of utilities and healthcare, is
Yeah.
this a cause for concern? What could be the possible reasons, implications of this?
So, barring utilities, if you look at healthcare, the sales growth has been pretty encouraging at 9.1%. In a quarter, it is possible that you could see some margin compression due to cost pressures, etc., but not too much to read into. Overall basis, if you're growing sales at 9-10% in line with GDP and profits growth with a stable margin, that's more than encouraging sign for the large caps.
Got it. So in terms of who came out on top, it's clear that materials are the clear winners. But who are the key contributors across the top companies?
Yeah, so as we see here, you had majorly oil and steel companies, right? Indian Oil, JSW Steel, Tata Steel, BPCL. Uh, Other than the uh, monetary policy and fiscal policy push, here we can see that the global trend towards rising metal prices, rising commodity prices, that is also getting reflected in uh, the financials of these companies. Um, the fiscal push is and monetary push is seen in one of the leaders, which is Mahindra and Mahindra, came out with a stellar set of numbers where the PAT increased by 1,000 crores or grew by 34%.
Got it. This was on the large caps. Coming to the next segment, which is our mid caps.
Mm.
Especially in the capital markets, both mid and small caps had seen a bit of pain over the last 18 months. How does this earnings report signal the way forward?
So if you look at the broad YOY PAT growth, that is at 26.7%, which is lower compared to what it was last quarter. But by any means, 26-27% PAT growth is not a small number, right? So it's a pretty healthy growth. Last time around, it was not backed by much of earnings growth. The revenue growth. Revenue growth was sub 10% last quarter, but this quarter we have a very healthy 14.5% revenue growth as well. So while the PAT growth has decelerated a bit, the sales growth is pretty encouraging. Um, in terms of sectors, again, consumer discretionary here you can clearly see it showed a 20% earnings growth. Something like real estate, which could be classified as a consumer discretionary also, right? That again showed a 33%, 34% sales growth and a PAT growth in line with the same. IT, on the other hand, while people would believe that there is disruption, etc., but at least on a historical basis for the quarter ended December, companies like Coforge, Persistent, they did pretty well, and hence you see a jump in PAT growth for IT in the mid cap segment.
Got it. So
Utilities
is
again.
this something that is a positive sign, or we should take it with a pinch of salt that this may not signal what's to come?
Uh, at least from the management commentaries and the earnings call of these companies, they continue to iterate and reiterate that AI will be a big opportunity for them. But the fact of the matter is nobody knows, right? Even the best of the minds who are developing these technologies are not sure how these things will unfold. And hence the market is trying to discount that uncertainty in IT. But earnings wise, at least the facts that we have in front of us do not tell us or give us an indication that we should be worried about these companies. It's more the outlook and the disruption upcoming.
Got it. Any commentary on the numbers that we're seeing in industrials, real estate, and also the large negative number again that we're seeing in utilities?
Yeah, so utilities, as was the case in large cap, in mid caps also, they continue to drag. They've also had a good run previously, right? So that that part of the market, it's not working as of now. You can say it's not firing currently, but and as and when we see that there is more consumer discretionary, the obviously the spend towards consumer, the utilities goes down, or it becomes stagnates. So yeah, with a low inflation, of course, you don't expect much of earnings for utilities either.
Right. Again, coming to what work across the top contributors,
Yeah,
clearly it's a mix of few different things, unlike as we saw in large caps. Can you just
correct.
tell us what this trend signifies?
Yeah, so there is, unlike large cap where there was a theme with where commodity players like petroleum refiners or steel players did well. Here there is no theme. You have everything ranging from a Yes Bank to MRF, right? Everything, all these companies did pretty well. If you notice, three of the companies, Lloyd's, BSE, MRF, they doubled their quarterly PAT compared to last December, and that indicates there is growth for those who want to seek, right? That you can find companies which are growing at a solid 25-30% CAGR in that universe. Whether the valuations are right or not, that is a question that money managers will have to think about.
So, just to simplify this, does this signify that the market is now not poised to give a broad-based rally, but rather a few pockets that we could identify that would move upwards or downwards?
Yeah, so was reading a couple of brokerage reports yesterday, and uh, that was a consensus call where everybody and it's visible in the numbers also, right? Where earlier you had a lot of companies delivering good results. Now you have this bifurcation coming in clearly, where you have some companies doing well, better than the others. So yeah, not a broad based rally that one should be expecting, but a more uh, bottoms up approach, or a stock specific action is something that we can see, especially in mid caps.
Understood. So, coming to small caps, what does the story tell us here? We've seen a lot of pain, especially on the price movement in the index over the last, especially calendar year 25, even if you take it back another 6 months, 18 months.
Yeah.
But the earnings numbers are surprisingly refreshing to look at. So, can you just tell us what's played out here?
So small caps have done okay. While we see that earnings growth is stable, the sales is at 10%, YOY PAT is at 14.8%. Both sales growth and PAT growth are lower compared to last quarter, which was not the case with mid cap or large cap. In case of large cap, both of them were higher than the previous quarter. In case of mid cap, this at least the sales growth was higher than the previous quarter. So some sort of deceleration in earnings growth, sales growth for the small caps. But again, the margins remain stable, and there are certain sectors where we are seeing rapid growth. For energy, for example, seeing a very high growth of 149%. This would be your solar power panel manufacturers, etc., the high growth areas where you have smaller players which are doing well.
Yeah. And what would the reason be for some of these like industrials, IT, where they've shown growth in sales, but revenues have come down significantly, PAT has come down significantly?
Yeah, generally that is the case for small cap. If you notice just the year-on-year PAT growth for the small caps, um, it tends to be more volatile compared to the other two segments. So
Got it. And utilities, although it's shown a degrowth in sales, it's turned a profit.
yeah,
What could this be the function of?
again, slightly better profit margins could be a reason, lower inflation, etc. But the thing is, even if it is turned from loss to profit, it's not a very meaningful number. Like if you come from -1 to 0 or 0.1, while it looks like lost profit, but it's not a very meaningful jump. So looking at the sales, one would see that utilities continue to remain under pressure.
Got it. And again, similar to large and mid, what trend are we seeing here across the companies that are bringing up the earnings in small caps?
So here, if you notice, out of the five companies which have the highest PAT growth in the small cap segment, four of them are PSUs. So your CPCL or owned by a PSU company, right? A subsidiary of a PSU. So CPCL, Mangalore Refineries Engineers India Limited or Shipping Corporation. Except for IFL Finance, the rest of them are PSUs. Uh, Other than that, there is no evident theme available, or you can say they are more linked to manufacturing. But again, IFL Finance breaks that classification because it's a financial services NBFC company.
Got it. Again, is this growth in PSU a function of what we've seen in terms of monetary policy, what's happened, the rate cuts? Is it a function of all of that?
Yeah, one would like to believe whatever steps that the government has been taking to improve the uh, efficiency of these companies, that is coming into play, because fiscal policy and monetary policy would do little to boost earnings for something like an Engineers India or Shipping Corporation, right? But it could be more on the consolidation, better management of these companies, uh, which could be playing out. But still, an initial early hypothesis. You need to wait out and see if they continue to deliver strong growth.
Got it. Coming to what's played out in terms of management commentary, uh, what the trends were, what the key growth triggers were, and the sectors that it affects. Can you just give us a brief on what we're looking at?
Yeah, so we did this small exercise where we took a lot of transcript from earnings call this quarter, and we fed it to various LLM models and tried to find out that what were the key themes or the key triggers that company management are looking forward to or are bullish about, right? So these are the top five that emerged. So one is the domestic cyclicality. So most companies believe that the consumption trends, yeah, are improving, the incomes are rising, and that should fuel consumption going forward. So that was one strong insight that came out from various management commentaries. Second was a lot of companies were bullish about or bullish because of infrastructure and capex spend because of the by the government. So all the in fact, even on the private side, the capex is starting to pick up a little bit, right? So both government and private capex coming together and developing the infrastructure of the company should have a structural tailwind. So this is very positive for companies who provide machinery, commercial vehicles, uh, raw materials so in form of metals, minings. Then the third theme was global demand recovery, uh, wherein most managements hope as the geopolitical tensions recede, we should see more stable global demand and recovery in the demand. In fact, even the IT companies, they are expecting that while the uh, tech spends have been limited, they are hoping that they will get a larger share of budgets and larger budgets, tech budgets will be there in FY27. And the other two were more very company specific, not larger themes. So companies moving towards premiumization, right? The ones shifting towards that, they are benefiting. So in your product mix, if the companies have products with higher margin and a more premium product for the consumers, those are seeing that hypothesis play. Obviously, we've as a consumer, we ourselves have experienced that whatever we are consuming, we want to go one notch, two notch higher in terms of quality. So the same thing is playing out, and management are expressing that as well. For financial stability, was the fifth indicator, indicating that going forward and even currently, the financial stability is a positive trigger for us. Us as in India, corporate India, and our growth.
Got it. So, what does this exactly signify? If you could just break down the nuanced bit of this. How does this translate across sectors?
So these are key five themes which will impact every sector in a different way, right? Um, uh, so infrastructure capex boost will should benefit heavy asset heavy businesses like your mining or metals companies, etc. Domestic cyclicality is a positive for any consumer discretionary or even FMCG companies to an extent. And you have global demand recovery for the exporters. So across these three, four schemes, most of the companies get covered. So depending on how the company is placed, whether it benefits more from exports, more from government infrastructure spends, or more from the consumer spends, they should have one of these or maybe more of these drivers playing out for them going forward.
Got it. Now, to bring all of this together, we've looked at how the large, mid, small has played out across sales and PAT growth, what the key triggers were, how they're positioned, what we expect them to do. But how did it look in the context of Deserve's portfolio, mainly our flagship equity revival strategy? How are we positioned and how are we looking to capitalize on all of the things that have happened?
Yeah, so as our ERS strategy invests into various mutual funds. These mutual funds invest into various companies. We've partitioned these companies in three categories: large cap, mid cap, small cap, as per the SEBI definition. And also, we've made a cross tab of these companies with overweight and underweight. Now, that overweight and underweight is with respect to the BSE 500 index. So, we can have a company which is large cap in nature, and our portfolio is overweight on that company, right? So, that's how you read this chart. Now, if you look at the first table, you will see that large cap, the overweight part of our portfolio grew by 15.1%, right? So, see, the stocks where the fund managers with whom we've invested, mm, those companies had a 15.1% sales growth, whereas the ones which we were underweight had a sales growth of 5.3%. At an aggregate level, as we saw, large cap delivered 8.7% growth. In mid caps, again, the sales growth for our overweight companies was faster. It was at 17.7% versus the underweight companies in mid cap grew by 12% YOY sales. And for small cap, the overall overweight small cap segment that grew sales by 11.2%, whereas underweight sales growth was at 9.6%. So on all the three segments, we the sales growth was higher in the overweight companies and lower in the underweight companies. On an overall basis, if we see, the overweights grew by 15.4% and the underweights grew by 7%. Now, when I say overweight and underweight, it does not mean that we are not present in the underweight category. Those stocks would also be present in the portfolio, but the weightage of that stock will be lesser compared to the weightage of that stock in the index. Now, if you were to look at the same uh, uh, classification, right? Large cap, mid cap, small cap, overweight and underweight. From a profit growth point of view, we will see that in the large cap segment, the overweights grew slower compared to the underweights. The overweight profit growth was 11.2%, and the underweight profit growth was at 16.1%. In the mid cap category also, there will be a couple of anomalies here where there could be a one-time profit or jump. You see that overweights growing at 10.9% and underweights growing at 43.8%. Uh, Similar story in small cap, but the overall growth, if you see, the underweights are grew at 8.9% and the overweights grew at 10.6%. Now, immediately that of course raises a question that is the profit growth for the overweights in our portfolio slower? The answer is yes, for one quarter it has been slower. But what we need to look at is the sales growth, which is the lead indicator of your profit growth. So generally, your fund managers would like to take a position in advance in anticipation of profits and not after the profits have come in or the after the profit growth has showed up. So not necessarily a cause of worry. Still looks decently poised. The sales is growing for the overweight companies as 15.4%, much higher than the GDP. And the valuations are also not very expensive for the portfolio.
Understood.
Uh,
So just to bring it back a little bit, this is
yeah.
in terms of how it's positioned, but to for the broader audience, if you could just walk us through how it is we actually construct this portfolio, it will give us better insight into how we manage to build a portfolio that could capitalize on all of this.
So in order to construct a mutual fund portfolio, Kushal, we look at five things, for four things, which we have an acronym called FAST. Right? F stands for fundamentals, A is for allocation, S is for skills of the fund manager, and T is for trend. Right? So first we look at the fundamentals of the portfolio. Let's say if we are looking at ICICI Approved Blue Chip Fund, we will look at the companies under that and aggregate the fundamentals. And by fundamentals, I would mean what is the valuation at which the companies are trading at, what is the growth. And by valuation and growth, we will have multiple parameters. For valuation, we will have price to earnings, price to book, price to sales, price to cash flow, dividend yield, etc. For growth, we will look at profit growth, sales growth, earnings growth, um, cash flow growth, profit growth. Also, there are two ways we look at. One is the historical profit growth, and second is forward-looking profit growth for that. So that is your fundamentals portion. The second, we come to A, which is allocation. In allocation, we see that how much of the portfolio or the fund is allocated across mid cap, large cap, small cap, what portion of the portfolio is in cash. Those are the things that we try to understand in allocation. In S skills, we try to attribute the performance of the portfolio to stock selection versus everything else. So whatever returns that have been generated, was it due to stock selection or was it because you got a sector right, you got a company right, or you picked the right theme at the right time? So we exclude all the gains made by those sort of factors and we isolate that how much was made purely out of stock selection. That is the skills. And finally, we have trend T, which tells us about that under various macroeconomic regimes, how does uh, the portfolio, which portfolio benefits more. Uh, so let's say in a rising interest rate scenario, a value portfolio tends to do better than a growth portfolio. In a high interest rate scenario, again, value tends to do better than growth. In a risk on sort of a scenario, small caps tend to do better than large caps. So various regimes and how themes play out during those regimes is what we check. So combining all these four, we finally select our funds and create a portfolio of our equity mutual funds, which is ERS.
So that is broadly on how we identify the top funds, right? How do we then say that these are the number of funds we want in the portfolio and then go about in terms of position sizing?
Understood. So mm, we take funds across the universe. Our universe is all the equity mutual funds except for ELSS and sectoral thematic funds. So our universe comprises roughly of 450, 500 mutual funds. Uh, Within those mutual funds, we have certain constraints saying that, okay, we want at least 45% to 50% exposure in large cap. Uh, we want mid cap and small cap, sorry, the outlook where the uh, of the category though that is put in place. So let's say if large cap has a better outlook over mid cap, the models will try to choose more of large cap or allocate more towards the large cap funds compared to the mid cap funds. We will have constraints in terms of number of funds, both on the upside and the downside. On the downside, we don't want to invest more than 25% in a single fund. And in case it is a large cap, in case it's a mid cap or small cap, we don't want to invest more than 15% in a single fund. So those constraints will be put in place. And finally, we'll try to create a portfolio which is diversified across styles, etc., and tries to generate alpha over the benchmark, which is BSE 500 or NSE 500.
Understood. So just to reiterate for the wider audience, the portfolio that we build is built across market capitalizations depending on what sort of macro regime there is, what sort of market cap we feel is poised to do better. But all of this is also aligned with the fact that we want to position this strategy as a low volatility strategy. Is that correct? Where we would then build it in such a way that we would try to generate alpha over the 500 while maintaining a low volatility position.
Right.
Got it.
Kushal, we just wanted to share the relative valuations also. If I can just share my screen.
Yeah, please go ahead.
Let me know if you are able to see my screen.
Not yet. Yeah, it's visible now.
Great. So, Kushal, we spoke about growth. Just wanted to touch upon valuations as well. Here I have the PE of Nifty 500, right? The dark blue line is Nifty 500 PE. It's a trailing PE. 10-year average is the orange line. One standard deviation up, you have the green line, and one standard deviation below is the blue line. Currently, you will see that Nifty 500 PE is trading between the below the 10-year average and slightly above the one minus one standard deviation range. So it's on the uh, n- not undervalued, but let's say somewhere in the fairly valued zone. Relative to USA, you will see that we have gone below one standard deviation. So compared to the US markets, valuation wise, India looks much more attractive. If you look at the PE of Nifty 500, right, against emerging markets, here instead of PE, we have plotted the premium and discount. So generally, we trade at around 70-80% premium to emerging markets, but we are currently somewhere around 40% uh, premium to emerging markets, which is below one standard deviation, right? Uh, in terms of trailing PE versus China, again, we have plotted the premium. So we generally trade at 130-140% premium to China's PE. Currently, we are below 90%. So that is also one standard deviation below. So while we have seen good growth across all the segments, across most of the sectors, except for a few, uh, the valuations have also come off sharply. Yeah.
Got it. So, does this also make us more attractive relative to our emerging market peers? And if so, is that a signal for FIIs to look at us from a different lens?
Yeah, but the thing is, unless you have some sort of stability in geopolitics, right, which scares the FIIs about moving their money out of dollars. And second, more clarity on how AI is going to change the world. It could be difficult to see FII flows for some time, but yeah, once we have this clarity, there is no other reason left for FIIs to stay away from Indian markets.
Got it. And finally, coming to how we look at portfolios from a holistic asset allocation approach, if you could just quickly give us a once over of what our stance is on in across the different asset classes.
Mm, So, on equity, we are saying that we want to go, we should be deploying our full capital. We don't need to stagger. In case we will be gradually increasing our allocation towards mid cap and small cap, at least as of now, what the visibility that we have, that's the case. For fixed income, you should avoid taking a very long duration bet. Instead, invest for in a 1 to 2 year kind of a bond, uh, and you can use liquid for parking your uh, short term proceeds. While we have written arbitrage here, that has to be relooked because there have been two implications on arbitrage now. One is the STT that got changed in the budget, and second is the SEBI recategorization of funds. So liquid is something that we can look for parking short-term proceeds, but any other, the longer-term money in fixed income can be invested in 1 to 2 year bonds. And for precious metals, we continue to suggest that 10% should be invested in gold and uh, through our strategy Shine, which also takes allocation towards silver opportunistically.
Got so thanks, Prateek. That was great. A very good recap of the earnings season and the valuations. It appears that you've done such a tremendous job at explaining this that we've had a handful of questions only. So I'll,
Otherwise, yeah.
yeah. So just quickly, a few impending questions are, so we saw that the valuations have come off, earnings look to be stable across market caps. Does that mean that this is now a good time to buy or go overweight equities, or should we stick to our asset allocations?
Always recommend that we should stick to our asset allocation, right? If because uh, as we have discussed in our previous webinars also, if you move away too much from your asset allocation, that means you are moving away from your risk appetite. If your risk appetite does not permit, you will not be able to hold the asset class for not just equity, any asset class for a very long period of time. Even if it is debt, it will make you uneasy, saying that I'm not getting returns. If it is equity, you'll feel it's too volatile. So sticking to the asset class is the best approach. But yes, if you have fresh money to deploy into equity, you need not stagger it. You can deploy that upfront.
Got it. And in terms of the earnings trend, do we see this continuing, especially with the GDP number again coming at a high number, the
Yeah.
inflation reset to a new series? Do all of these play a part? Are they telling us the right story?
So both are separate questions, right? One is, will the earnings growth continue? In all probability, it looks like it should not just continue, but get better as we move ahead and get into FY27. Um, the reason for that is clearly that last year we had headwinds in form of rising interest rates, fiscal policy being very tight, etc. But now we have tailwinds in form of interest rate cuts. We have pretty low interest rates. It seems like they'll be there for a long time. Um, Somewhere down the line, if US cuts rates, that is not so cutting rates for India is not out of uh, it's a possibility, right? Uh, Even on fiscal policies front, we had a good budget. Again, the while maintaining the prudence and without overspending, or we are moving towards fiscal consolidation at the same times, increasing spending as well. So. little reason to believe that the growth will not be higher or sustained going forward.
Got it. And finally, in terms of what's happening around the globe, there's still a lot of uncertainty, especially with the Iran and US situation. How should India look at it? Are we insulated? How do we handle something like that?
So these things can, move, go get out of control very soon, and with little time for an investor to react. The best way to deal with this is to have some safe haven kind of asset in our portfolio. And that's the reason we have been recommending to invest 10% of your portfolio into Shine, which is a strategy that holds gold, or take exposure towards gold in a form and format that is comfortable with you. So yeah, any kind of geopolitical uncertainty further, it does dampen the capital market spirits, generally the global growth, as well as uh, the flows that we see from abroad. So to that extent, having some sort of asset class like a gold will be helpful in that portfolio.
Got it. Thanks. Thanks a lot for this, Prateek. Thanks for this very insightful session. And thank you, folks, for joining us here on a weekend. We hope you found this session
Uh,
helpful. And yeah, Prateek.
Sorry, Kushal. I think there is one more question related to the overweight performed lower than underweight.
Just a second.
If we can just take that
Right,
one.
sure. So the question is the overweight performed lower than the underweight.
Yeah.
And since our team looks at sales growth, which should lead to profit growth, the same the case in the previous quarter as well. So any commentary on that?
Yeah. So the one thing missing out of here is the stock prices, right? So let's say if you are the companies where you are seeing a higher profit growth, but that has been valued and those stocks have run up, you would not want to continue investing in them. Possibly, a reporting of higher profit growth without a sales growth would be a good indication to get out of those stocks. So you notice that while the underweights are generating more profits, their sales is not growing. So uh, in case of overweights, while you have sales much higher compared to the underweights, the sustainability of profit and revenues is much higher. Second is, as I said during the presentation also, that underweights does not mean we do not have any exposure there. It simply means that we will have a smaller exposure compared to the index over there. So even in case there are a couple of misses, it does not impact the portfolio very heavily.
Understood. Got it. Thank you. Thank you very much. Thank you,
Thanks.
everyone. You will be faced with a feedback form, as I mentioned earlier in the presentation. Please do fill it out. It helps us deliver better content week on week. Thank you very much for your time. Thanks, Prateek.
Thank you.